Okay, let's dive in. We're cracking open the Bain and Company India Private Equity Report 2025. Really want to understand the pulse of private capital in, well, one of the world's fastest growing major economies.
And, the title itself tells quite a story, doesn't it?
Yeah.
A New Horizon. PEVC investments find balance after a 2-year descent. It immediately signals, okay, 2024 was some kind of turning point.
A turning point right after that 2-year descent. That's the key phrase. So,
Yeah.
what exactly shifted? Our mission here in this deep dive is really to unpack this report for you, pull out the most important insights,
Yeah.
figure out what 2024 actually looked like for PEVC in India, how capital is flowing, where it's going, and what does that suggest for 2025?
Think of it as cutting through all the data, maybe getting straight to the crucial takeaways, the key trends, the hot sectors, how funds are actually raising money, making exits,
Uh-huh.
and what the outlook is,
Hmm.
all kind of distilled for you.
So as we go through this, what aspects of India's investment landscape stand out most to you personally? Let's sort of unpack this together. So first things first, what was the big picture for India's private capital market in 2024? Was it, another tough year, or did things start looking up?
Well, the report is quite clear on this. After those 2 years of contraction, India's PEVC investments saw a definitive recovery in 2024.
Okay, recovery, good start. What did that look like in actual numbers?
The rebound meant investments grew by approximately 9% year over year, landed at around $43 billion in total.
9%, $43 billion. Okay, and who was driving that growth? Was it like traditional private equity or more the venture capital side?
Yeah, interesting point. The resurgence was almost entirely fueled by venture capital and growth investments. Traditional PE deal making, it was significant, but it stayed relatively steady compared to the previous year.
Let's dig into that VC surge then. How much did VC and growth investments actually jump?
They surged by a pretty significant amount, around 40%, hitting roughly $14 billion.
40%.
Yeah. But the fascinating part, I think, is that this surge wasn't just about bigger deal sizes. It was mainly driven by a massive increase in deal volumes.
Ah,
VC deals went from 880 in 2023 to a striking 12,070 in 2024.
wow, that's a huge jump in the sheer number of deals. And which sectors saw a lot of that VC action?
Consumer tech was a major engine here. Funding in that specific sector jumped about 2 times, reached roughly $6 billion.
Okay.
Meanwhile, as we said, PE investments, they stayed steady, around that $29 billion mark.
Why do you think PE was kind of flat while VC activity just exploded? Any reasons?
The report suggests PE funds face some headwinds, particularly around valuations. The buoyant public markets in India. Great for exits, obviously.
Right.
But they seem to inflate expectations in the private market, made it challenging for PE funds to find deals at prices that, met their return targets.
So high public valuations made private assets feel expensive.
Got it. Despite that, did India still hold its ground in the region? Oh, absolutely. India actually strengthened its position. It's the second largest PEVC destination in Asia-Pacific now, capturing about a 20% share of the total investment. That consistency, even with those PE challenges, it really highlights India's fundamental attractiveness.
Yeah, that makes sense. And within the PE deals that did get done, the report points to this big strategic shift towards buyouts.
Yes, this is a really key takeaway. Buyouts gained significant prominence. They accounted for 51% of total PE deal value in 2024.
51%.
Yeah, that's a substantial leap from just 37% back in 2022.
So PE funds are moving from being maybe significant minority investors to wanting actual control. Is that the idea?
Precisely. They're actively acquiring controlling stakes.
Yeah.
The goal seems to be having more direct influence, to drive value creation, really get hands-on,
Right.
which is often a key strategy when funds have a lot of capital they need to deploy effectively.
Okay. On the flip side then, how was the fundraising environment? Were funds able to raise capital for these India-focused investments?
Well, 2024 was actually a record year, particularly for domestic fundraising. The report highlights Kadara. They closed their largest fund ever at around $1.7 billion.
Wow.
And looking just ahead into 2025, Christ Capital secured about $2.1 billion. That marks the country's largest ever domestic fundraise.
That's huge scale for domestic funds. Are global players also increasing their bets on India?
Yes, definitely. Commitments from global funds, even government-linked investors, seem to be accelerating. The report actually mentions Blackstone aiming to double its assets under management in India.
To $100 billion, wasn't it?
Yeah, $100 billion. Temasek adding $10 billion to its portfolio here. Qatar Investment Authority planning $10 billion and actually opening an office. And KKR expecting to deploy its next $10 billion in India faster than before.
That kind of commitment from the global giants, that's a really strong signal, isn't it?
It is.
What about exits? Were investors actually able to cash out, get returns?
Yes. Exit activity saw a big surge in 2024. It was up 16% year over year, reaching approximately $33 billion. So investors definitely capitalized on those attractive public market valuations we talked about.
Right, the valuations again. And public markets were the main exit route.
By far. Public market exits reached a record, roughly $20 billion, making up about 59% of the total exit value. That's up from 51% in 2023.
Okay.
And this was driven by, well, increased IPO activity, but also large block trades selling shares directly into the open market.
So just putting 2024 together sounds like a clear recovery, but led by VC volume. PE was steady, but making that strategic shift to control through buyouts. Fundraising was strong, attracting big global checks, and exits were robust, mainly thanks to that healthy public market. Gives us a good overview.
Exactly. It sets a complex, but I'd say overall positive backdrop heading into 2025.
Okay, let's dig a bit deeper into those deal-making trends then. We established PE VC investments grew 9% to $43 billion, fueled by VC growth surging 41%, while PE was basically flat, minus 1%.
Right. And because of that VC surge, the total number of deals increased significantly. But, since VC deals are typically smaller, the average deal size across the whole market actually declined by about 20%.
Ah, okay. So more deals but smaller deals drove the volume momentum, especially at the sort of lower end of the ticket sizes.
Exactly. The bulk of the increase in deal volume came from those small ticket size deals, mid to large deals, slightly fewer in number maybe, but their volume compared to 2023 was still pretty consistent, around 0.9x to 1x, so holding steady.
The report does list some pretty impressive large deals in 2024, though, which shows scale is still possible. Can you share a couple of examples?
Sure. Top deals included Perficient, that was $3 billion in ITITES.
Yeah.
ATC India at $2.2 billion, that's real estate and infrastructure. Zepto, consumer tech, around $1.355 billion. And Manjushree, $1 billion in advanced manufacturing.
Big numbers.
Yeah, they highlight the diversity and scale. And importantly, PE investments still accounted for a steady share of those really significant deals, the ones over $100 million.
Let's revisit that shift in PE investor behavior, that strong preference for buyouts. The report really emphasizes this, right? Buyouts jumping from 37% to 51% of PE deal value between 22 and 24. What's the real significance there?
Well, this isn't just a statistic, is it? It feels like a strategic evolution. It means PE funds are increasingly looking to acquire control of companies.
Right.
This allows them to be more hands-on, implement operational changes, really drive value creation over their investment horizon, rather than just, say, riding market growth as a minority shareholder.
Okay.
It signals, I think, increasing maturity in the market and maybe funds confidence in their own ability to add that operational value.
But you mentioned those valuation challenges earlier. How did that tension between funds wanting control and potentially facing high asking prices, how did that play out?
Yeah, that was a key friction point, particularly for traditional PE deals.
Mm-hmm.
The strong performance, the high valuations in India's public markets, they kind of set a benchmark, didn't they?
Mm-hmm.
And private market sellers often had similar, high expectations. This definitely made closing deals at acceptable entry valuations difficult for quite a few PE funds, even as they were eager to deploy capital.
So the spillover from those buoyant public markets was a bit of a double-edged sword then. Great for exits, obviously, but challenging for new PE investments, unless maybe they were structured as buyouts where control offered clearer pathways to create value.
That's a good way to put it, yeah. Funds surveyed for the report specifically called out high valuation asks as a key concern, something that complicated deal closures in 2024.
Okay, that gives us a clearer picture of the deal environment. Now, where was all this capital actually flowing into? Which sectors were the real hotspots?
The report clearly identifies 4 leading sectors that attracted, the lion's share of PE funding. That's financial services, ITITES, healthcare, and real estate infrastructure. Activity elsewhere was more muted.
Let's start with financial services then. What was driving growth there?
Financial services grew by about 25%. And that was largely fueled by a resurgence in non-banking financial companies, the NBFCs.
NBFCs.
Yeah, the report notes specific drivers within NBFCs like affordable housing finance, microloan against property or LAP, and lending to micro, small, and medium enterprises, MSMEs.
Any specific examples mentioned?
Deals like Shriram Housing Finance, Vastu Housing Finance, DMI Finance are in there. The sector also saw activity in wealth and asset management deals involving entities like NSC and Neo Wealth Management.
And the outlook.
Still look strong,
Yeah.
especially for those affordable housing LAP MBFCs and wealth management, driven by growing demand, expansion to smaller cities, Tier 2, Tier 3, and just attractive underlying economics, recurring revenue, stickiness.
Okay. IT and IT saw that massive surge you said around 4x. What was behind that
Oh,
specifically?
yeah, it was heavily influenced by a couple of very large buyouts, specifically Proficient and Altimetric. Those two accounted for something like 80% of the sector's entire deal value.
So skewed by mega deals. But was there also activity in that more niche area mentioned, revenue cycle management, BPOs?
RCM.
Yes, RCM BPOs were a notable subsegment. This is essentially the business side of healthcare administration, right? Billing, payments.
Got it.
India has a significant advantage here, talent, cost. And the report points to substantial headroom for offshoring these services to India. So companies like JBS, V, Infinx became attractive targets.
Makes sense. Healthcare deals also jumped significantly in volume, didn't they?
Absolutely. Deal volumes were up around 80%, and investment spread across several areas. MedTech saw large transactions like Healthium and Abapasamy, pharma CDMOs.
Remind us what CDMOs are.
Oh, right. Contract development and manufacturing organizations. Companies that manufacture drugs or devices for other pharma companies. Deals there included Myva and Orbicular. And investments continued in healthcare providers, regional hospital chains, single specialty hospitals, that kind of thing.
And the report takes a closer look at medtech and CDMOs, highlighting future growth potential. It does. For medtech, growth is expected in areas like diagnostic imaging, cardiology, consumables, driven by factors like, rising craft conditions, tech advancements, increasing disposable incomes, and also the need for customized implants, point-of-care testing.
And there's a big export angle for medtech, too.
Yes, the report projects a pretty significant export opportunity. Around $78 billion by 2030, India is expected to increase its share of global medtech exports, fueled by demand in emerging markets and, interestingly, growing acceptance in Europe.
Okay. And for CDMOs, what's the outlook there?
The global CDMO market itself is seeing robust growth, and India is gaining share within that. Key areas for Indian CDMOs include injectables, high demand, outsourcing needs other final dosage forms like topicals, ophthalmic products, and also active pharmaceutical ingredients, API, particularly as patents expire on existing drugs.
Right, the patent cliff opportunity. Finally, real estate and infrastructure, that was the largest sector for investment overall, you said?
Yeah, it accounted for about 16% of total PEVC investment, and it grew by about 70%. Infrastructure funding saw a really dramatic surge, around 5x, led mainly by that large ATC telecom tower deal, but also significant investments in road projects, clearly boosted by government initiatives and successful public-private partnerships, PPPs.
And real estate itself, what was the focus there?
That activity was primarily in residential developers and projects, kind of capitalizing on the post-COVID boom, especially the really strong demand in the luxury housing segment.
The report also detailed growth prospects within different parts of the real estate market, right?
It did. Commercial real estate remains lucrative. Stable cash flows, demand from global capability centers, those GCCs.
Right, the offshore operations.
Exactly. Plus startups, data centers. Residential is still riding that post-COVID wave of higher incomes, need for bigger spaces. And warehousing. Massive growth potential there. Driven by 3PL, quick commerce, and global manufacturers shifting supply chains to India. Think Apple, Samsung, Foxconn. Very attractive area for investors.
But retail real estate seems to be the outlier, the one lagging behind.
Yeah, the report notes sort of subdued growth in retail real estate transactions. Factors include, the continued rise of e-commerce, maybe some investor caution about ghost malls, and infrastructure limitations in some areas.
So these four sectors, financial services, IT, healthcare, and reinfra, they really highlight where investors are seeing the most compelling growth stories in India right now, it seems.
They really are the focal points where capital is most actively being deployed based on all those underlying growth drivers we just discussed.
Okay, moving from where the money is going, let's look at where it's coming from. The report states pretty clearly that India remains a key priority for fundraising within the Asia-Pacific region.
Absolutely. India is attracting significant and actually accelerating commitments from both domestic and global investors.
We touched on those record domestic fundraisers, Kadara and Christ Capital. Huge numbers.
Yeah, those are landmark raises for the Indian market. It really shows the growing scale and, frankly, capability of domestic fund managers.
And it sounds like global funds aren't just, dipping their toes in anymore. They're making massive commitments.
That's right. The examples in the report are quite telling, aren't they? Blackstone aiming to double its India AUM to $100 billion. Temasek adding $10 billion. QIA planning $10 billion and setting up shop locally. KKR deploying its next $10 billion faster. I mean, this isn't marginal stuff. These are strategic, large-scale allocations.
It really paints a picture of India as a non-negotiable market for the major global players.
It does. And the report notes something like 87% of the top 30 global funds are already active investors in India. The availability of capital is just immense.
But with all this money-chasing opportunities, has the fundraising landscape for individual funds become more competitive? Is it harder to raise a fund?
Oh, definitely. The report points out that the number of funds active in India has increased by 65% just since 2016.
Wow. How does that increased competition then impact what the investors, the limited partners, the LPs are looking for when they allocate?
Well, it puts pressure on fund managers to demonstrate performance, doesn't it? LPs are demanding stronger track records. The report indicates 56% of funds surveyed felt past performance was a critical factor in securing follow-on funding. It's definitely a market where results matter more than ever.
What are the underlying reasons for this sustained high level of global and domestic interest in India? Why now?
The report attributes it to a combination of structural factors, really. Significant reforms over the past, say, 7 to 8 years, GST, the Insolvency and Bankruptcy Code, IBC, the Real Estate Regulation Act, RERA. They've improved the overall business climate.
Right.
Then you have FDI liberalization, which has opened up more sectors, and importantly, accelerated digital transformation. Things like the JAM Trinity.
Linking bank accounts, mobile, and ID.
Exactly. And the whole Digital India initiative.
Yeah.
These have created genuinely new, high-growth opportunities that weren't there before.
So strong macro fundamentals combined with those structural improvements and digital adoption. That's making India incredibly attractive for capital, despite the crowded market and the need for proven performance.
I think that sums it up well. It's a market offering significant potential, but definitely one that requires sophistication and a strong track record to navigate successfully, especially from a fundraising perspective.
Okay, now let's talk about the other side of the investment cycle, exits, where investors actually cash out. The report calls 2024 a marquee year for exits. Sounds impressive.
It certainly was. Exits jumped approximately 16% year over year to about $33 billion. And there was a record 360 exit volumes. So investors were actively taking advantage of those favorable conditions to monetize their positions.
And as we touched on earlier, public markets were the dominant route for that.
Resoundingly so. Public market exits hit a record around $20 billion, accounting for 59% of the total exit value. This was driven by those attractive public market valuations, yes, but also strong domestic investor inflows into the stock market, providing liquidity.
So IPOs were a big part of that $20 billion.
Yes, IPO exits surged, about 2.2 times in value, reaching around $4 billion in 2024. But interestingly, non-IPO public market exits things like block trades, bulk trades, where large shareholders sell big stakes on the open market. They were even bigger.
Really?
Yeah, it grew 20% to about $15 billion. The report mentions examples like Trent, PNB Housing.
It sounds like if you had an investment ready to exit in 2024, the public market was just the place to do it.
The survey confirms that pretty starkly. 100% of funds surveyed cited healthier public market performance as the key driver for their successful exits last year.
100%. Okay, what about sponsor-to-sponsor sales? Where one PE fund sells a portfolio company to another PE fund. How did those fare?
Those deals remained steady, or maybe even contracted slightly. It seems the high public market valuations made private transactions, including S2S deals, relatively less appealing, or perhaps more challenging from a valuation perspective for the buyer fund.
Got it. Which sectors saw the most successful exits overall?
Financial services and consumer retail exits really soared, primarily through large public market sales. Names like BSV, Trent, PNB Housing, Visual Megamart come up. Healthcare exits were a bit more diversified, spread across S2S, strategic sales to corporates, and public routes.
Is there still a strong pipeline of potential IPOs coming up?
The report does list several significant IPOs apparently in the pipeline. Companies like Zetwork, Dr. Agarwal's Healthcare, Urban Company, Advance Financial Services. However, and this is crucial, it adds a note of caution. The corrections we've seen in the public market since late 2024 could potentially temper this momentum, so something to watch.
Right, market conditions matter. Finally, the report mentions something called aging assets. What exactly are those, and how do they factor into the exit picture going forward?
Aging assets are simply older investments that funds have held for maybe a longer than average period. The report highlights that the typical holding period for investments is actually increased.
How so?
Well, for example, fewer large PE buyouts from the 2018-2019 vintage, so deals done then, were exited within 5 years compared to similar deals from the 2012-2013 vintage. The number was 36% versus 50%.
So funds basically have a growing backlog of older investments they haven't managed to exit yet.
Exactly. This accumulation of aging assets means funds have a substantial pool of investments that are nearing or maybe even past their typical hold period. And to return capital to their own investors, their LPs, they need to find exit routes for these companies.
Oh, okay.
So this creates a sort of built-in pressure that is likely to expedite future exit activity. It could add momentum to the exit market in the coming years, potentially even driving more sponsor-to-sponsor deals if public markets become less favorable for IPOs or block trades.
Interesting. So 2024 was a strong exit year, especially via public markets. And the combination of continued public appetite, if it holds, and this internal need to divest aging assets suggests the exit market should remain pretty active going forward.
That's the general expectation, yes, with the always important caveat that public market conditions remain a key factor.
Okay, so looking forward then, based on everything we've discussed from the report, what's the overall outlook for India's PE/VC market in 2025? Optimistic? Pessimistic?
The report describes the outlook as cautiously optimistic. That seems to be the key phrase for PE/VC funding activity.
Cautiously optimistic. What underpins that optimism? What are the good signs?
Several supportive macro factors, really. India's robust GDP growth trajectory continues. Inflation is cooling, there's the prospect of easing interest rates, and importantly, signs of a potential consumption recovery.
You mentioned consumption recovery. Is there real evidence of that happening? Because that's been a concern.
Yeah, it has. But the report points to some positive indicators.
Yeah.
Things like volume growth in fast-moving consumer goods, FMCG, and growth in real private final consumption expenditure, basically. Household spending power is picking up. And government policies, potential RBI rate cuts down the line, are expected to further boost consumption, which is particularly good news for investments in consumer and retail sectors, obviously.
And those hot sectors we discussed earlier, financial services, healthcare, consumer retail, real estate, are they expected to remain the primary focus for deals?
Yes, the report anticipates continued strong deal-making in these areas. There are specific growth drivers that we talked about, MBFCs expanding beyond Tier 1, medtech and CDMO export potential, recovering consumption, warehousing demand. Those are expected to persist and continue driving investor interest.
What about the investors themselves, the LPs and the funds? Any shifts expected there?
LPs, like the big sovereign wealth funds and pension funds, they're likely to continue increasing direct investments and co-investments, seeking maybe more control or better economics. Fund managers, in turn, are expected to keep building out their operational teams to actively drive value creation in their portfolio companies.
So more hands-on.
More hands-on seems to be the trend. However, the report does note some LPs might still maintain a degree of caution, just given the global landscape.
And will buyouts continue to be the preferred deal type for PE, that control theme?
The report predicts buyouts will remain a cornerstone of PE strategy, yes, as funds continue to prioritize acquiring control to implement those value creation plans and deploy capital effectively at scale.
So that's the optimistic side of the coin. What are the potential risks? What tempers that optimism?
Global uncertainty is flagged as the primary risk factor. This includes things like potential U.S. tariff threats, broader trade war tensions between major economies, and the continued depreciation of the Indian rupee against the dollar. These kinds of external shocks could potentially impact the otherwise favorable domestic outlook.
Right, external factors. And what about the outlook for exits specifically in 2025? Still strong?
Exit momentum is projected to remain strong, yes. The report expects this to be partly driven by an increase in sponsor-to-sponsor deals as funds look to offload those aging assets we discussed.
Ah, the backlog effect.
Exactly. Continued IPO activity is also anticipated, though again, this is highly dependent on how the public markets perform, especially after those recent corrections.
So, summing up 2025, looks potentially positive, supported by strong domestic fundamentals and that internal pressure for funds to exit older investments. but with a very watchful eye needed on the external global environment.
I think that's a fair assessment. It's a balance of significant tailwinds and potential headwinds that will likely define the year ahead.
Well, we've certainly covered a lot of ground in this deep dive into the Bain Company India PE Report 2025. We've seen how 2024 marked that clear rebound, driven mainly by VC deal volume, while PE held steady, but made that key strategic shift towards buyouts, towards control.
Hmm.
We've explored the sectors attracting the most capital financial services, IT, healthcare, and real estate infra, and really tried to understand their specific growth drivers. We looked at the robust fundraising environment, attracting record domestic raises and significant global commitments,
Yeah, that global piece is key.
and examined the strong exit market, dominated by public listings, but with that challenge, or perhaps opportunity, of aging assets creating future exit pressure.
Understanding these dynamics, it really does provide a powerful lens, doesn't it?
Hmm.
On the flow of capital and the engines of growth within India's, well, incredibly dynamic economy.
And the outlook for 2025, as you said, cautiously optimistic, thanks to improving macro conditions, maybe a consumption recovery, but still tempered by those potential global uncertainties. Plus, that backlog of aging assets adds another layer of complexity and maybe opportunity to the exit landscape.
It's definitely a market poised for continued activity. Navigating both those domestic strengths and those external variables will be key.
So here's maybe a final thought to leave you with as you process all this. Given the report highlights both this cautious optimism and global uncertainty, how might the interplay between India's strong domestic story and those external risks actually shape the type of opportunities and challenges that ultimately emerge for investors in 2025? Could it favor certain sectors or deal types over others? Something to ponder.